We're joined now by a long-time oil market observer who says even with this OPEC production cut, there's a good chance that WTI ends the year lower. Jason Schenker joins us now, president of Prestige Economics. Jason, great to see you. Feels like a long time. So you think there's a real chance here that WTI goes down during the balance of the year?
Yeah, that's right, Andy. It's great to be here with you today. The biggest thing is, and this is part of the reason OPEC cut production levels, is they're watching the global economic backdrop, and the global economy is slowing. We see global manufacturing is currently contracting. That's a really big problem. We've had contractions in China. 7 of the past 11 months, their manufacturing is contracted. We see that in the Caixin manufacturing PMI. In the Eurozone, it's contracted the last 3 consecutive months. And while U.S. manufacturing in the ISM is still conveying an expansion, it's rather tepid. So if we see growth continue to slow on these higher rates, there's going to be some more oil demand destruction, something we've been expecting since we talked earlier this year about it in the summer.
What about the determination, though, of OPEC Plus to keep supply down? I mean, that was, gutsy might not be the move, but it was a provocative move. I mean, they must have known it would irritate President Biden.
I think right now they're really watching the global macro story. I've often described OPEC as the central bank of oil, and looking at the rapid rise in interest rates, the potential for more Fed rate hikes ahead, the potential for global growth to slow drastically, all of that, including the risks of an emerging market sovereign debt crisis. I think that's part of the reason they've cut production here in order to stabilize price. And while prices have gone up sharply in the last few days, we could find that they do give back quite a bit of that rise as we see growth data slow for most of the global economy in the weeks ahead.
Are we looking at a downturn, a real recession in many countries?
In many countries, we are likely to see one. I think the question is now whether we see deep recessions in a lot of countries or wide recessions. And by that, I'm thinking about in the United States, we've already had 2 negative quarters of GDP consecutively. We could have more ahead. Will they be big negative quarters? Maybe not. Maybe it's a lot of small contractions ahead. But there's still going to be a lot of contractions. And in the U.S., we're probably in a much more favorable spot than many other economies. I think emerging markets, particularly at risk, the Eurozone at risk, China at risk. All of that presents a lot of downside to oil demand globally.
What about the U.S. dollar? Because that's a problem, an inflationary problem for a lot of countries around the world because their imports are often priced in the U.S. currency, particularly energy.
Absolutely, Andy. And one of the bigger problems, too, with that stronger dollar is that actually creates more price pressure across emerging markets, not just for energy, but also for food prices that have risen a lot. Another reason we see the risk of a slowing global economy. That strong dollar is definitely having lots of ripples. And right now where inflation is, the Fed doesn't look like it's done raising rates, more rate hikes ahead. And of course, if oil prices find themselves more supported, and if there's more upside to natural gas prices this winter, which we believe there is, that inflation could prove sticky and interest rates rise even further.
Is it a myth that central bankers can actually achieve this soft landing, gently modulating down the pace of the economy?
I think it really depends who you ask how soft a landing it is. I think people who don't lose their jobs in the process will probably tell you it was soft. Those who do will have a very different opinion. What we're seeing right now is the labor market is just so strong in the United States that as those interest rates go higher, we're getting negative GDP. We're seeing weakening economic indicators. But there's still a very low unemployment rate, a very low number of jobless claims. There's a lot of great labor market data. And as long as people have jobs, the Fed's only job is inflation, something Fitcher Powell talked about at Jackson Hole this year.
Yeah, it's interesting. No real sign of a turndown in the labor market. I know it tends to lag other phenomena in the economy.
Yeah, the only area we really see it, there's a series of data, layoffs.fyi. They produce announcements of startups that are having layoffs, both by the number of jobs cut and the number of companies announcing layoffs. And the first 3 quarters of this year is worse than the first 3 quarters of 2020. In other words, even though there was the outbreak of COVID that resulted in lots of layoffs in the startup space, the most recent 3 quarters, very, very challenging. But that really shouldn't be surprising because startups are often operating in the more you lose, the more you're worth mantra. And while that may work a bit better at 0% interest rates, Fed funds rate moving up very quickly here makes it a lot more difficult to justify.
Finally, give us your, let's put up a 1-year chart for oil. Do you see oil stuck below $100 US in North America for the time being, Jason?
There could be spikes here and there, especially as we find maybe a pile-on effect after this OPEC decision. But with global growth slowing, it seems very likely we're going to be below $100 for a number of quarters ahead. The only area I'd be looking at, the end of Q1, beginning of Q2 is where we see refineries begin to ramp back up. If we still see that the global economy is in good shape, then there could be quite a bit more upside because that's when refineries gear up for that summer driving season in the United States, the biggest global seasonal driver of oil prices. But that would be, until then, the end of Q1, beginning of Q2, there's still a lot of downside, especially with higher rates, slowing growth. Those factors present a lot of risk to the downside.